Hello world economic news for whatever day it is. First chart is a Bob Shiller chart going back to 1890 for a housing index in the United States. This is really to show how much money was ploughed in to that last peak. That's all. It's all about how far it's still got to fall, that red spotty line. But all I'm pushing is there's an awful lot still invested in that large peak. Moving on. Soft is pundits' new hard sell. The number of homes on the market in April doubled compared to the same period a year ago. Does this mean it's truly a buyer's market at last? Property pundits are labelling it a buyer's market. Clearance rates are low, the glut of properties for sale shows little sign of abating, and prices are now negotiable. Even market's most bullish supporters are bending before signs of softer conditions. Melbourne's auction, yes, Australia. Is Australia now actually cracking, even before China cracks? When China cracks, double cracks. You tax paper, I tax potato. EU-China tariff battle heats up. Paper and potato starch manufacturers may be the first of many victims in the battle between the EU and China over alleged illegal subsidies. I'll go to the middle paragraph there. European legislators getting more and more worried about the challenge from Chinese companies moving up the value chain, have used countervailing duty against China for the first time. When the going gets tough, you protect what you've got. Dubai Bank taken over by the government. That's protecting what you've got. House prices, well, call it house prices in Dubai, are down about 50%, something along those lines, since 2007. Banks are cracking, so they're taken over by the boss, the country. Guardian Co UK. Greek crisis forces thousands of Athenians into rural migration. Debt, unemployment and poverty is causing mass unrest and thousands to seek a cheaper lifestyle outside the capital. Rents particularly are very expensive in the capital, in the cities in general. So they're moving off to the country. I hope they're very happy there. UK, this is from the Financial Times. You will have all got this information. CPI annual inflation stands at 4.5%, up from 4% in March. Doesn't look good. Well, it'd be all right if commensurate wage rises were happening, but they're not. But the pips are not squeaking yet. Have a look at this little chart of the amount or percentage of spending that is spent on food. Let's start at the bottom. Nigeria, Indonesia, India are all 25 to 30%. Then you've got a clump of Russia, Brazil, Chile, Mexico, around about 20%. Thailand, Saudi Arabia, South Africa, Argentina and China, 12, 15, that sort of percentage. So underneath China we have Japan, where food is expensive. France, it's expensive because they like to spend money on food. And then Finland, Australia, Canada, Germany, UK, Singapore, I would have expected Singapore to be more, and the US at under 5% of spending is spent on food, under 5% in the United States. The pips are not squeaking yet. Those figures will have to go up an awful lot more. See, what's happening is let's go back to that opening chart. In your mind, a lot of money has gone into that peak. Where's the money come from? Various places. You can say China, Japan, Arab petrodollars, but a lot of it is capital, just invested, saved capital from United States people, and it's invested via the banking sector, financial intermediaries, into housing. And it's also invested in those financial intermediaries. So the big question is, how can this be managed? What are the central banks to do, or what is the Fed to do in this case? Because if it lets deflation come in, then an awful lot of those monies, the direct investment and the investment in the banking sector, is going to be lost. The people are going to be lost, they'll lose their houses. The financial sector will lose because they'll have to write off much more of this stuff and show themselves to be insolvent beyond any fantasy. And the people that have invested, lending the money and investing in everything, lose their investments. I can't see how this can be let to happen, but one man that can, I'll put an extra link in. If I can manage it, I'll embed Russell Napier talking to John Authors of the Financial Times, and see what you think of what he has to say, because it's the obvious answer from history, says that Napier should be right, but I don't see how it can possibly be allowed to be right this time. Bye.